In November 1923, in Germany, money stopped meaning anything. A loaf of bread didn't cost thousands or millions. It cost hundreds of billions of marks. Savings that once represented a lifetime of discipline became scraps of paper overnight. An account that could have bought a home just a few years earlier could barely buy food. 5 years was all it took for a respected currency to collapse into nothing. Most people were wiped out. Not because they were reckless, but because they trusted rules that only work when the system is stable. And yet, not everyone lost everything. Some people endured. A few even came out stronger. Not because they predicted the collapse early, and not because they were lucky, but because they were positioned according to realities that keep working when systems fail. Fast forward to Argentina in 2001. Banks shut their doors. Withdrawals were frozen. People were told their money was safe, right before the government forcibly converted dollar savings into pesos at an artificial rate. Within months, 2/3 of purchasing power vanished. Families who did everything right woke up poorer overnight. Again, most people suffered. And again, some didn't. Now, look at the present. The US carries tens of trillions in debt. The dollar has lost nearly all of its purchasing power over the last century. Trillions of new dollars were created in just a few years. The pattern is not new. It has played out repeatedly across civilizations, currencies, and political systems. Whether the next crisis unfolds in 5 years or 15 is unknowable. But history is clear about something else. When the break happens, the outcome depends far less on timing and far more on positioning. This isn't about predicting disaster. It's about understanding what holds up when everything else doesn't. Most financial advice today is built for continuity. It assumes markets function, banks remain liquid, contracts are honored, and institutions enforce rules. When those assumptions break, the advice collapses with them. History shows that when systems fracture, the same few forces keep determining who preserves value and who doesn't. When currencies fail, paper promises dissolve. Numbers on a screen are only as good as the system backing them. When that system breaks, claims become unenforceable, but physical reality doesn't disappear. In early 20th century Germany, bank balances evaporated, but land still produced food. Buildings still sheltered people. A factory still manufactured goods. Prices changed wildly, but the underlying utility didn't vanish. The same thing happened in Zimbabwe decades later. Money died, but farmland, tools, and livestock still mattered. During Argentina's crisis, financial assets were trapped or revalued, but businesses that provided necessities kept operating. Across collapses, ownership of tangible real-world assets consistently outlasts ownership of financial claims. There's also a critical difference between things that produce value and things that only represent value. Assets that generate food, shelter, energy, or essential services continue to matter regardless of market sentiment. Assets that rely on resale demand often don't. During the Great Depression, prices for stocks collapsed and buyers disappeared. But farms still harvested crops. Rental housing was still needed. Small businesses that served daily needs remained relevant, even as paper wealth imploded. More recently, in places like Venezuela, market indices soared in nominal terms, while the currency collapsed. The numbers went up, but real living standards collapsed. Meanwhile, bakeries, mechanics, transport operators, and farmers, people connected to production, retained leverage. Speculation depends on confidence and liquidity. Production depends on necessity. History favors necessity. Debt is another dividing line. In good times, borrowing amplifies gains. In bad times, it magnifies destruction. When income falls, but obligations remain fixed, leverage becomes a trap. During the 1930s, millions lost land not because they lacked property, but because they owed money against it. Those who owned assets outright endured hardship, but survived. Those who didn't lost everything. The same dynamic played out in later crises. When currencies fell and wages collapsed, debt obligations didn't adjust fast enough. Foreclosures followed. Ownership without leverage proved far more resilient than leveraged ownership. Inflation can reduce the real value of debt, but only if income keeps pace. In true systemic stress, it usually doesn't. Beyond assets and balance sheets, there's one form of value that repeatedly survives confiscation, inflation, and displacement: human capability. Property can be seized, businesses can be nationalized, currency can be reset, but knowledge and skills move with the individual. Throughout history, displaced populations who rebuilt fastest weren't those who had owned the most before the collapse, but those who could create value wherever they landed. Doctors, engineers, tradespeople, technicians, and builders retained relevance even when stripped of possessions. From early 20th century revolutions to post-war migrations, the pattern repeats. Skills outlive systems. Finally, when institutions weaken, survival shifts from centralized structures to personal relationships. When governments falter and formal systems stop functioning, people rely on trust, family, neighbors, community. Food is shared, labor is exchanged, security becomes local. This isn't theoretical. It has happened repeatedly, from post-Soviet economies to financial crises in South America and the Middle East, where institutional trust evaporates. Social trust becomes the real currency. Modern life has outsourced nearly everything to systems we don't control. Food, safety, finance, even social interaction. That efficiency comes at the cost of fragility. History suggests that resilience grows in the opposite direction. What matters isn't owning the perfect asset or predicting the exact moment of crisis. Those are tactical questions, and tactics change with circumstances. What matters is aligning with forces that keep working when conditions change. Real assets don't vanish when currencies fail. Productive assets create value, regardless of sentiment. Debt amplifies fragility. Skills travel, and communities endure long after institutions weaken. These aren't theories. They are observations drawn from centuries of collapse and recovery. They improved survival odds in ancient empires and modern economies alike. And they remain relevant not because history repeats perfectly, but because human behavior and incentives don't change. The collapse doesn't announce itself. By the time certainty arrives, options are gone. Positioning early doesn't require panic. It requires understanding what persists when everything else breaks. History has already shown the pattern. The only open question is, who chooses to learn from it before the window closes?